Good morning, traders. Today, we're breaking down the core order flow concepts commonly used to analyze how the auction behind the market builds value over time, and more importantly, the logic behind each one. Before watching this video, I strongly recommend checking out my previous video on how order flow works. Understanding market microstructure will help you grasp these concepts much more clearly. Today, we'll break down step by step. Absorption and exhaustion, failed auctions, finished and unfinished auctions, imbalances, Iceberg orders, delta divergence, trapped traders, and low-volume nodes. Let's begin. Let's start with absorption. Absorption refers to a situation in the auction process where large passive limit orders absorb the initiative pressure coming from aggressive market participants. In other words, aggressive orders continue to enter the market, but price suddenly stops progressing in the direction of that aggression. Initiative buyers or sellers are still active, but they are now meeting significant resistance. How do you recognize absorption? Large aggressive volume appears at the bid or at the ask. Delta expands strongly in one direction, but price stalls or fails to make new highs or lows. This tells you that a passive participant is providing liquidity and absorbing the incoming flow, preventing continuation. However, absorption alone does not guarantee a reversal. For a full shift in direction, you still need follow-through aggression on the opposite side. Absorption simply tells you that the current initiative pressure is being challenged. This concept becomes extremely useful in different contexts. If you trade mean reversion, absorption can help confirm potential turning points. If you trade trend continuation, it can warn you that structure may be weakening and a shift could be approaching. Absorption is not a signal. It's information about participation. Now, exhaustion is different. Exhaustion happens when aggressive activity progressively fades, unlike absorption where aggression is still strong but absorbed. In exhaustion, the initiative pressure simply weakens. This often occurs when a trend becomes mature. The auction becomes increasingly expensive for participants to continue pushing price higher or lower. Early buyers or sellers begin to take profits, and fewer new participants are willing to enter at extreme prices. Instead of seeing large aggressive prints, you start to notice smaller volume at the extremes, delta losing momentum, price struggling to extend further, volatility decreasing. You may still see price making marginal new highs or lows, but the participation behind the move is thinning. This is a sign that initiative activity is drying up. Exhaustion does not mean immediate reversal. It means the fuel behind the move is weakening, and when aggression disappears, the market becomes vulnerable to responsive activity on the opposite side. Now let's talk about failed auctions. A failed auction occurs when the market attempts to establish new price levels, but fails to build acceptance beyond a key reference point. From an auction theory perspective, an auction is considered successful when price moves to a new area and finds participation there. A failed auction happens when that participation never materializes. This concept is commonly observed using volume profile. For example, when price breaks above the value area high or below the value area low, it is attempting to enter price discovery. But if the market quickly rotates back inside the value area, that breakout attempt has failed. It means the market is not accepting those new prices and prefers to return to previously established value. In practical terms, price explored higher or lower levels, but there was not enough follow-through or participation to sustain that move. A failed auction does not automatically guarantee a reversal, but it is one of the clearest signs that the market rejected the attempted expansion. And rejection at an extreme often creates opportunity for rotation in the opposite direction. Now let's talk about finished and unfinished auctions. To understand this concept, we need to go back to auction theory. An auction is considered complete when it finds a temporary balance at an extreme. In a balanced market, price rotates between buyers and sellers until one side loses interest. A finished auction occurs when the market pushes to an extreme, a high or a low, and that extreme shows completion. What does completion look like? At the very top or bottom of a move, you typically see decreasing volume, lack of continuation, little to no further aggressive participation. This suggests that the auction has fully explored that price level. There are no more participants willing to transact at worse prices. The auction is finished at that extreme. Now let's compare this with an unfinished auction. An unfinished auction occurs when price reaches an extreme, but the auction does not show signs of completion. In footprint terms, this may appear as continued two-sided activity at the high or low of the candle. Instead of drying up, volume is still actively trading at the extreme. This suggests that the market has not fully completed its exploration of that price level. In simple terms, a finished auction shows rejection at the extreme. An unfinished auction suggests unfinished business. However, this does not mean price must immediately return to that level. It simply means the auction did not show full completion there. Finished and unfinished auctions are tools to understand whether the market has truly completed its exploration of a price level. Now let's talk about imbalances. An imbalance represents a clear dominance of aggressive activity at a specific price level. In a footprint chart, this is observed when the volume traded at the ask significantly exceeds the volume traded at the bid, or vice versa. But to understand imbalances correctly, we need to remember something. Trades occur across the spread, so imbalances are typically read diagonally. We compare the ask volume at one price level with the bid volume one tick below. When aggressive buyers lift the offer with significantly more volume than sellers hitting the bid below, we identify a buying imbalance. The opposite is true for selling imbalances. Most platforms define an imbalance using a ratio threshold. For example, 3-to-1 or 4-to-1. This means that one side is trading at 3 or 4 times the volume of the other side at adjacent levels. An imbalance highlights localized initiative dominance. It tells us that one side was significantly more aggressive at that moment. When multiple imbalances stack consecutively in one direction, this shows strong initiative pressure pushing through the order book. However, imbalances alone do not guarantee continuation. Aggression must still be accepted by the market. If imbalances appear but price fails to progress, that could indicate absorption or weakening participation. So imbalances are not signals. They are measurements of dominance at specific price levels. They show who was pushing, not whether that push will succeed. Now let's talk about iceberg orders. An iceberg order is a large limit order that is intentionally hidden. In most exchanges, traders can choose to display only a portion of their total order size. For example, a participant might want to buy 1,000 contracts, but instead of showing the entire size in the order book, they only display 50 contracts at a time. Once those 50 contracts are filled, another 50 automatically appear at the same price. This process repeats until the full order is executed. That's why it's called an iceberg. Only a small portion is visible. The majority remains hidden beneath the surface. From an order flow perspective, an iceberg can be suspected when large aggressive volume repeatedly trades at a price level, but the resting liquidity at that level does not disappear. Price struggles to move beyond that level. In other words, aggressive participants keep hitting the bid or lifting the offer, yet the level continues to hold. This suggests that a larger passive participant may be absorbing the flow using a hidden order. However, it's important to clarify something. You cannot directly see an iceberg order in most retail platforms. You infer its presence from behavior, not from certainty. Icebergs represent large passive liquidity defending a level, and like absorption, they do not automatically imply reversal. They simply indicate that significant liquidity is present. Now let's talk about delta divergence. Delta divergence occurs when price and aggressive participation are no longer aligned. Remember, delta measures initiative aggression. Price measures outcome. A divergence appears when one is moving in one direction while the other is not confirming it. For example, price makes a new high, but delta, or cumulative delta, fails to make a new high. This suggests that although price is pushing higher, the aggressive buying behind the move is weakening. Delta divergence is essentially a form of effort versus result analysis. If effort is decreasing while price continues to extend, participation may be thinning. However, it is important to understand, delta divergence does not automatically mean reversal. It simply tells us that initiative pressure is no longer expanding in line with price. This makes the market more vulnerable to absorption, exhaustion, or structural rejection. In simple terms, when price makes new extremes without new aggression, the move may be losing fuel. Now let's talk about trapped traders. Trapped buyers or trapped sellers appear when aggressive market participants enter the market expecting continuation, but the auction fails to move in their favor. For example, buyers aggressively lift the offer, pushing price higher with strong positive delta. However, shortly after entering, the market stops progressing higher. Price stalls or even starts moving lower. This means those initiative buyers are now trapped in losing positions. If price continues moving against them, those traders will eventually be forced to exit their positions. And when trapped traders close their trades, they create additional momentum in the opposite direction. For example, if trapped buyers start selling to exit their positions, their exits add selling pressure to the market. This is why trapped traders can accelerate reversals. But remember, trapped traders are not identified by a single candle. They are identified by the relationship between aggression and result. When aggressive participation fails to produce continuation, someone in the market is likely trapped. Now let's talk about low-volume nodes. Low-volume nodes come from volume profile analysis. A low-volume node is a price area where relatively little trading activity occurred. In auction terms, these areas represent inefficient price movement. The market moved quickly through those levels without building much participation or agreement. Because of that, low-volume nodes often act as natural rejection areas. When price revisits a low-volume node, the market frequently moves through it quickly again, or reacts strongly around that level. Why? Because those prices were never fully accepted by market participants. In other words, low-volume nodes represent areas where the auction moved too fast to build balance. This is why traders often use them as potential reaction zones or areas of continuation. They highlight where the market previously lacked participation, and markets tend to move quickly through areas where little trading occurred. Thanks for watching. If you enjoyed this breakdown, make sure to leave a like and drop a comment below. I'd love to hear your thoughts. And if you want more content on order flow, futures, and trading strategies, don't forget to subscribe and follow us on our socials. See you in the next one.